Welcome back to the channel. You know who this is, B.O.B. None but the best of the best, baby. And if you're interested in money, business, credit, all kinds of different tips and tricks on how to grow your business, you're in the right place. Make sure you guys like and subscribe to the channel. So today, without further ado, I've got a very special guest I'm going to bring in here. His name is Josh Broder, and he's a private wealth manager and president of Centurion Wealth Management. I'm going to bring him in right now. How you doing, Josh? How was everything?
I'm great. How are you?
Doing wonderful, doing wonderful. I appreciate you joining us here on the channel today. And tell us a little bit about yourself, because we've talked quite a bit, and we've gotten into all kinds of pretty interesting conversations about the state of the economy right now. What can we expect here in the future, and also a little bit about what you do and how we can possibly help provide the information and help clients navigate this terrain as it is right now.
Yeah, sure. So, again, my name is Josh Broder. I am a private wealth advisor and the president of Centurion Wealth Management. We are a franchise of Ameriprise Financial, as you can see here. And we operate in about 41 different states in the country, with our headquarters being here in Connecticut, where I am. I've been doing this for almost 2 decades, and we have a team of 12 people, 6 advisors, 6 concierge staff, here to help you. We manage money for people. We help people put together financial plans for retirement, for sending their kids to school. We help small business owners quite a bit. Because, as you know very well, there's a lot of opportunities that business owners have that regular W-2 employees don't have, specifically in the world of retirement. Instead of putting 20 grand in your 401k, how about if you were able to put away $125,000 pre-tax and don't pay the government taxes on that, right?
Absolutely.
We have ways that we can help you do that, right?
Amazing.
So
Amazing.
that's what we do for people. We've been doing it for a long time, have a lot of skill doing it, and manage about $500 million on a daily basis for our clients as of right now.
Amazing, amazing. So, everyone's talking about the downturn and a recession and things like that. What are you seeing on a day-to-day when, you're out here, you're in the financial sector? What are you seeing, and where do you see things going?
Yeah, good question. So an hour ago, the Federal Reserve raised rates another 0.75% today. We knew that was coming, but they are starting to talk now about, kind of easing back on raising the rates here. So theoretically, they're scheduled again in December to meet and potentially raise rates again, which, if they do, most likely will not be 0.75%. Will be less than that if they do anything at all. I think it's very interesting right now. Obviously, this is one of the roughest years we've seen in the market overall in a very, very long time. But it's kind of the perfect storm of everything happening at once, not one specific external force like, the last major downturn, 08, 09, when you had the mortgage meltdown, financial crisis. That's not what this is, right?
Right.
Due to COVID, the government gave out lots and lots and lots of free money.
Yes.
Right? Well, guess what? Somebody's got to pay that money.
Yeah.
Right? And because of the influx of dollars into the system, right, that's why we're seeing the inflation that we're seeing. On top of that, after Putin invaded Ukraine, earlier this year, the rising energy prices that we saw early this year were minor, but that exacerbated everything and kind of made it significantly worse. We've come way, way, way back down from when oil was $124 a barrel. Now we're in the 80s, but it's creeping up just a little bit now, kind of going into home heating oil season. And the Fed, the Federal Reserve, really has no impact on inflation at this point, right?
Mm-hmm.
At the beginning of the year, they raised rates and it cooled down the real estate market, which was great. And people aren't buying with mortgage rates at 7+%, right? Very, very little. You're certainly not refinancing after the last few years.
Right.
But, them continuing to raise rates is really having no impact. However, as most of you will know, we obviously have a midterm election next Tuesday. And the way we see it happening is Republicans are going to take back the House. That's kind of a given. Whether or not Republicans take back the Senate, we're not sure. It's about a 50-50 call right now, and is probably going to rest on Herschel Walker versus Raphael Warnock in Georgia, which is a very, very interesting race. In fact, our people see it as a runoff election will happen in December, and the fate of which party controls the entire United States Senate will come down to how many people in the state of Georgia come out to vote a second time in a month.
Okay.
Which is crazy.
Yeah,
absolutely
that is crazy.
And utterly crazy. But here's the good news. Let's assume Republicans take back the House and Democrats control the Senate, right? Historically speaking, in a midterm election of a first-term president, which we're seeing here, when there is a Democrat president in office and a split Congress for the next 2 years, the market has averaged just under 30% a year for those next 2 years. Now, don't get me wrong. I don't think we're averaging 30% a year for the next 2 years, right? What it means, though, is that historically speaking, the market reacts really well with a Democratic incumbent president and then a split Congress thereafter. And the closer we get to the magic number of 37 seats in the House being flipped during this, the more it signals a potential change in the White House 2 years from now. But honestly, we need to get through today and tomorrow before we can think about 2 years from now.
Exactly. So this whole quantitative easing that's taken place, the inflation is crazy. We know it. And therefore has resulted in the Fed raising rates, right? As you very well said, it's caused a little bit of a slowdown in the housing market, which was super hot, right? But so is everything else. Now, me and you were a part of the same group, Exotic Car Hacks. You love exotic cars, watches, all those, all the fun stuff, and it's been a great investment. Where do you see things going as far as on that level?
Yeah, it's a good question. So, what we think is for the next 5 years, we don't see the market having, insane years like what we saw, 2020, 2019, even 2021, for the most part. We don't see that. We see it as a much slower growth area. You have to realize for the last decade or so, all you have to do was throw some money in Apple or Google or Amazon, and you made a lot of money.
Yes.
Well, I think the days of those valuations, on less than stellar earnings for those tech companies is long over. And I think the way to make some money probably in the next 5 years is more what we call slow growth, right? Where you're going to see companies that are really well-versed in downturns and having good cash flow, right? So these are going to be companies, depending on how long war goes, defense companies, right? You're going to see companies that are consumer staples, right? Companies like Johnson & Johnson or Clorox, people still have to brush their teeth and they need toothpaste, right? They still got to wipe their butts and they need toilet paper.
Yes.
Right? No matter what's going on out there, they need these things. They're going to pay for them, right? And so you're going to see different types of companies, more what we consider to be value companies and less growth companies kind of come into favor, which already has happened and probably will stay that way for the next couple of years, unless there's an external force that changes things, which there very well may be, but we don't know that at this point. And so you're not going to expect 10 or 12% a year. You might really only get 5 or 6% a year in the market, which is why we're turning to alternative asset classes, right? As you mentioned, right? Cars, but not, a Honda Civic or, a Toyota Corolla, right? We're talking about more extreme higher end cars that hold their value, right? Luxury goods like watches, purses, art, things of that nature. Those are types of areas that generally don't move the same way as the stock market. A lot of people are into crypto. I
Mm.
think crypto is not a good investment right now, although it's really low.
Mm.
That's not where I would put my money. That's too big of a crapshoot, and it's not regulated,
Mm-hmm.
right? Things that are not regulated end up going, bad usually. And I'm not
Mm-hmm.
saying that's going to happen. I'm just saying I wouldn't throw all your eggs into that crypto basket of stuff that we don't even know if it's real.
Right. Absolutely.
Right? Put
Absolutely.
into real hard assets, right? A lot of people talk about in downturns, you want to buy gold and silver and whatever. I don't know. That was kind of back in the olden days, but
Yeah.
I think some of these more exotic type things, cars, watches, art, and even in the financial markets, things that have guarantees built in with certain rates of return, that minimize your downside. That's where I think the next few years.
Getting back to reality is what you're kind of saying. Instead of just overvaluations that didn't make any sense.
Correct.
I mean, all kinds of gains based on nothing but hype. So it seems like we're getting back to reality where a company is actually worth what they're producing or what their products are or what their balance sheets show. Right. Which is I think it's a good thing.
Think about it like this, right?
Mm-hmm.
During the pandemic, think about companies that went through the roof. Zoom, Peloton, Teladoc, right? Companies like that. Where are they now compared to where they were, let's say, in, December of 2020?
Oh, they're suffering.
Most of them are 70+%.
Oh, yeah.
If not more, below those numbers because they were ridiculous valuations on non-earnings and things that didn't exist. And you're exactly right. We're going back to the way it should be instead of the way it was. And you can't just blindly close your eyes and throw a dart and hope to hit something.
Right.
And, it's going to be all good. You need a professional, somebody like me, my group, that actually going to help you walk through this. And here's the other thing, right? Would you agree with me that there is no possible way that tax rates are going to go anywhere but up from here? Right?
Yes, I agree.
They're at literally historic lows in terms of the rates. It doesn't necessarily feel that way to everybody.
Yeah.
But the truth of the matter is this is the lowest tax rates that we've ever had in this country. That doesn't mean that you're paying less, just how they do it is a little different.
Yes.
So let's assume that tax rates go up over the next 5, 10, 20 years, right? Well, how do you get around paying some of these ridiculous taxes? And there's a lot of strategies and loopholes and all kinds of different things that specifically more wealthy people enjoy, and very specifically business owners enjoy more than the average American does.
Absolutely. So I've always wondered, inflation, we see it always go in one direction. Okay. Housing prices, luxury goods, the cars. I mean, everything, food, furniture's up 40%, everything. Okay. Is there such a thing as turning back the clock and going back in time to make some of these things come back into the valuations that they should be? Is there such a thing? Is that what's going on? Is that what they're trying to do with raising rates?
Yeah, so it's a good question. So, what the term for that would be deflation, right? Which is the opposite of inflation. So I think, and people don't think about it that way, but right now in the housing market, in most major areas, we're seeing deflation. Not huge, right? Although in some areas it is starting to get big. From what I see in Austin, Texas, Atlanta, Tampa, and Las Vegas specifically, in parts of Southern California, you're seeing prices more than 10% off the highs that they were earlier this year, right? And yes, deflation is a real thing, but it's always the easy thing to say. Things are going to go up very, very quickly and take a very long time to go down. And I think the price of groceries is the perfect example of that right now, right? So let's say on average, grocery prices are up 30% in the last couple of years. I do think prices are going to come down because part of the increase in prices is not a can of beans costing double what it is, but a lot of it is the fuel surcharges that the transportation companies are adding on because the higher cost of energy.
Mm-hmm.
And so as the cost of energy comes back down to earth, which it will, right? Because oil prices, when we talk about energy, are the most cyclical thing in the market. They will come back down and then they will go back up. But as that happens, the grocery stores, at least in my area, I know, they're sending 100% of that fuel surcharge onto the end consumer, which is why we're paying so much.
Right.
As prices come down, as diesel prices come down, the grocery stores will start to bring that price down. They're not going to make anything less than they're currently making because all they're doing is passing that off to us, and it'll look like to the consumer that prices are coming down, but don't expect it to come down 10 or 20%. If you get a 5 to 10% decrease over the next year, consider that lucky.
Okay. Awesome. So a lot of people say, there's always a saying, buy the dip, right? And, in this recession time, things are coming down a little bit. How far down? I mean, it's hard to obviously tell, but how far down do you expect things to go? How bad do you think things are going to get? And should savvy investors be looking to buy the dip in these in assets?
Yeah. Good, very, very good question. So there's a couple different ways to answer that question. So first and foremost, let's assume that Jerome Powell and the Federal Reserve does not put us into a major recession next year, right? We'll do both scenarios. If he doesn't put us into a major recession next year, we think we're already past the bottom.
Okay.
Not by a lot. At one point, I think the S&P 500 was down 26 or 27 this year, and right now maybe it's down 19 or something like that. So I think we're off of that bottom, but I still think we have a long way to go, and it's going to be a slow climb. So getting in soon is a great thing. The other side of things is, let's assume that Jerome Powell and the Fed puts us into a big recession, which, by the way, we do not think is going to be the case, but you never know.
Okay.
But let's assume he puts us into major recession by continuing to raise rates more than he should. What I think you're going to see is, I think the election next week is going to buoy the market up a little bit. We're going to see a Santa Claus rally at the end of the year, and we might end the year down half of where we are right now, though still not a good year. But I think if that happens, then what you're going to see is next year, we're going to retest those lows after we've gone back up. The average major downturn in this country averages 40% top to bottom. The worst that we saw this year was about 26, 27. So we're still another, let's say, 13 to 15% off of that. And generally it doesn't get any worse than that. So I would say worst case scenario, maybe another 10 to 15% if it happens.
Okay.
But I'm not convinced it's going to happen quite that way.
Okay. So you obviously were there during the 2008 crash. You saw, everything just really, really tumble. And it was, like you said, it was based on, the whole mortgage crisis at that point. And this is much different because there's many different facets that are contributing to this so-called downturn.
Yes.
What are some of the other major differences that you're seeing from 2008 and what we're going through today? And how can investors kind of navigate that?
Yeah, so good question. In 2008, 2009, it really started on that Monday in September when Lehman Brothers went under.
Right.
And then it was the mortgage meltdown, financial crisis, and all this other stuff. Well, there's a couple things that have to happen for it to get that bad. So first and foremost, you need to have high unemployment numbers, which right now we're at 3.5%, which is an all-time low. So it's not at a high rate right now. If we hit recession, a major recession, you're going to see those unemployment numbers go up, and you're going to see a lot of people out of work. I think the difference is there's a lot less people wanting to work now than there were in 08, 09 due to COVID and a lot of people retiring earlier than they did. So there's less of a workforce, even though the numbers look good, they're a little bit deceiving, right? Yes. I think the other major difference is there is not a financial issue anywhere out there right now with bad loans and bad debt and so on and so forth. I think one of the things that happened in 08, 09 was there were a ton of adjustable rate loans,
Yes.
mortgages, car loans, etc., that people haven't done since that point. And so people are locked in at these rates. So even if you bought a place at the height of the real estate market, let's say, November of last year, and you paid 100 grand more for a house, more than really you should have, but you paid 3% on your mortgage, your net payment is still less than probably what you were paying to rent.
Yes.
Right?
Right.
The other thing I think is that in 08, 09, we didn't see spiking inflation in terms of groceries, rental prices, cars, things of that nature, because there wasn't a supply chain issue that we still have right now. Right? There's a major supply chain issue, right? So yeah, furniture prices might be up 40%. That's not the issue. People are still willing to pay it. The issue is that it's going to take you 6 months to get what you ordered.
Yes.
Right?
Absolutely.
If you can get it in that time frame, right?
Absolutely.
I have 2 cars that I have on order, one of which I ordered 13 months ago, and they still haven't started to produce it yet.
Wow.
That's a problem.
Yeah. What did you order?
It's a, now it's a 2023 because they moved it from a 22, but a Cadillac CT5V Blackwing, fully custom, unbelievable,
nice.
Right? They've actually stopped taking orders on the 2023 now, and I have probably the nicest one spec'd anywhere coming if they ever build it. Maybe not. We'll see.
Right. Absolutely. Nice. Awesome.
Right? Which, by the way, if you do through your business, you can get a write-off on, but that's a different issue.
Absolutely.
Right? So, I think there's a lot of major differences between what we're going through now, what we went through then. But one of the fundamental differences between then and now is there were external forces causing what we had then, which caused declines in the economy and whatever. We don't have that now. I think the fundamentals in the economy are significantly better than they were in 08, 09. But it seems to me, living through it with my clients, myself, etc., this seems to everybody very, very different. In 08, 09, starting that day in September, the market went down tremendously for a couple of months. We really haven't seen those huge declines this year. We've seen consistent declines month after month. And so it feels like it's taking forever to hit the bottom before it comes back up, which makes it feel different to people. And I think the psychology of a downturn is very, very different today than it was, almost 15 years ago.
Absolutely. So have you noticed, in your travels, is it getting a little bit more difficult to get funding? I mean, how are banks reacting right now?
It's a good question.
Yeah.
So, I actually happen to be the vice president of a nonprofit organization here in Connecticut. And we're going through a major building remodel. And I actually earlier today was on the phone with our banker because we need $1 million more in funding. And I think what you're seeing from banks is it's a little bit tighter than it was, unless you can show really good numbers to them. If you can show really good numbers, they're willing to lend. It's just at a higher rate. And so, the cost of money being a lot more is making it a little more difficult. I think when it comes to, let's say, auto loans, right, rates are higher, but the availability is tremendously there. The product itself is not there. Right? Banks would love to be able to give you, a 60-month auto loan at 4.99% or whatever it is. Problem is you got to find a car to buy to be able to do it.
Right. True.
Right? For houses, who on earth is going to go and spend $750,000 with a $500,000 mortgage at 7%? No way. Just not, unless it's absolutely necessary. People are not going to do that. People taking out home equity loans, home equity lines of credit, even though they might have a ton of equity in their home because the prices are so high, the cost of borrowing is so high, it's not worth it anymore. Right? I don't think you're going to see a lot of these 0% interest, loans and things like that. But here's what I will tell you.
Mm-hmm.
All of our experts are saying that the Fed is raising rates on purpose more than they know they should, so
Mm-hmm.
that next year they can swoop in, cut rates, and seem like the hero.
Okay.
Problem is, if they did it too much and sent us into recession, didn't work.
Right.
Right?
Right.
So if they can thread that needle, not send us into a major recession, and then come in next year, swoop rates down 1% or whatever the case may be,
Mm-hmm.
you're going to now see things open up tremendously at some point, probably mid to second half of next year. And I think eventually, when the Fed is done with all their business,
Mm-hmm.
you're going to see rates settle in where they were pre-COVID. I'm guessing around 5% for a 30-year mortgage, but we're probably a year and a half to 2 years away from that, maybe more.
Okay. So this 12 to 18 months that we could still see a little bit of a correction, a little bit of uncertainty. What are you advising, or what's your take on what investors should be doing during this time, during this 12 months? Should we just be waiting, or should we be looking to buy? Should we be selling? What is it that we should be
Good question.
thinking about?
So worst thing you can do right now is sell if you're already invested, because all you're doing is locking in losses, and nobody wants that.
Right.
Right? If you're already invested, stay invested. Don't jump off the cliff. Don't be stupid. Right? Stay invested, because it'll always come back. It's just a question of when.
Okay.
If you have a tremendous amount of cash on the sidelines, right, for whatever reason, doesn't matter, there are opportunities that are out there now. There will be more opportunities coming up, whether that means the stock market, whether that means luxury items, cars, watches, art, whatever. There's also a lot of opportunities in buying cash flow products, right? And what I mean by that is real estate, if you can make things work, or businesses, right?
Mm-hmm.
So, buying an existing business, let's say a car wash that has positive cash flow of $100,000 a year, that including somebody to run it, well, you might need a few $100,000 to be able to buy it to produce that cash flow. But let me tell you, cash is king.
Yes.
Right? And so if you can diversify your income, diversify your net worth in your portfolio, you need stuff invested in the market. You need stuff in luxury items. You need stuff in real estate, in businesses, etc. And the most successful people in the world, how did they make their money? Business, right? They started a business, they bought a business, they founded a business, and then they sold a business for a huge exit later on. That is how people in this country and around the world become extremely wealthy, not, working at a company making $150,000 a year. Don't get me wrong. You do what you got to do for your family.
Yes.
But the entrepreneurial spirit and the starting a business, running a business, that's where people are going to make their money.
Absolutely. Absolutely. Well, this has been an absolute pleasure having you on, Josh. I appreciate your time very much. And you've given us some great insight into, what a person in finance like yourself is thinking and has those connections and what you're seeing on a day-to-day basis. So, any final thoughts that you want to leave us with?
Yeah, look, I've been doing this for a very long time, and I'll tell you this. Hang in there. Don't jump off the deep end. Take a deep breath. Don't look at your stuff every day. And call me so I can help you, especially if you're a small business owner, want to sock away a lot of money, etc. Myself and my dedicated team will be absolutely happy to work with you and put you on the right path.
Absolutely. Thank you so much. By the way, I will leave all of Josh's information in the link, all the links in the description of the video. Please reach out to him. As you guys can very well tell, he knows his stuff. Me and him have been talking, and the conversations have been so productive and so, it provided so much insight that I just had to have him on today, and it's been wonderful. So please reach out to him. All the contact details will be in the description below. Also, don't forget, leave a comment if you have any questions. We'll be checking the comments, and we'll be glad to assist you in any way that we can. So once again, Josh, thank you so much for your time, and it's been a definite pleasure.
Excellent. Thank you.
Alrighty. Catch you guys in the next video.